One of the things we talk about, guys and girls, is about money and where money flows and how money gets affected. So in the stock market, two things get affected. One, liquidity. Two, the earnings. What's liquidity? Liquidity is interest rates. If interest rates go up, it drives up liquidity, doesn't that? It drives up liquidity, doesn't that? So when it drives up liquidity, we now get a situation in which we see the market higher interest rates means that you're cutting off money, right? Does that make sense? They're cutting off the money. Okay? You can see it. You don't see the image now? You should see it now. So as the stock market, as the bond market goes down, interest rates begin to go up. As the bond market goes down in price, interest rates go up. That takes away liquidity to the market, which is why they're raising rates, which is why the bond markets is going down. Bond market comes down, and then they come in afterwards. Okay, fine. You see a market here. We'll put the volume in, and we see the markets. Here's some type of possible climactic action, right? The spring, and now the market's consolidating. Okay, so the market looks like maybe accumulation, but until you get that sign of strength, the market remains negative, right? So let's go to the bond market. You expect the bond market to go up, right? Interest to come down. Watch. The bond market is bigger than stock markets. Do you see this? The bond market has not reacted. That means the stocks are reacting to the upside with the bond markets. Going down. So you see the company. You see the market decoupling, right? So interest rates are going up as the market is stocks are going up. Something is wrong. Bond market usually right. Okay, because there's so many stocks that could be affected. So here, retest of high volume gets retested. Got to be tested. This normally in a bull market, this is where your buy would be, right? See this bar? Increasing volume, shorter downward thrust on a retest of this bar. In a bull market, you would buy this and walk away. But look how the market disregarded important areas. This is a very critical stage of the market. If this cause gets used up to the downside, interest rates are going higher, which will put pressure on stocks. You get a very bad next 3 months. So we're at a point now, right now, that the market needs to react from. So we take this long term, and we take this as out of a shorted thrust. It's still following a down move, but we're kind of oversold here. So you got to be careful of a short rally once you get above these highs. So the key is this market has to react. It cannot mark down. If this market marks down, stocks have a big break coming. Does that make sense to you? I can't express to you how you must look at this stuff over the next months. This is the cost of money. Higher interest rates cost you more for loans, cost you more for everything you do. Okay, if you're paying 5% versus 3%, that means you could buy 2% less goods, right? You could buy a house that's $300,000 and afford it with interest rate of 3%. If it goes up to 6%, you got a problem. So liquidity being dried up now by higher rates, earnings may or may not be there because they learn how to make money in spite of COVID wise. So the earnings could be good. The liquidity is becoming bad. That's not a recipe for a bull market. Does that make sense? This correlation of money, we talked about it months ago, is extremely critical. Initially, not a big deal. Initially, not a big deal. But now, you certain circuit interest rates. That's the case. Any questions? The cost of money, the cost of money is going up. Affordability to that money is going down. Does not make stocks attractive relative to higher rates because of loss of liquidity. And you have earnings there, but not liquidity. Bearish. Ultimately, that will cut the earnings. Then you'll have bad earnings or poor earnings than expected and higher interest rates. So watch these charts. It's extremely important that you understand that.